Gold and silver just hit a sharp reversal, and it's worth understanding what's actually driving it before drawing any conclusions. After a sustained run higher, both metals turned lower with enough force to stand out. Traders sometimes call these moves violent, not because of the size alone, but because of what they signal. A pullback this sharp usually reflects a shift in how traders are positioned, not a sudden change in the fundamental case for precious metals. So what triggers a move like this? Two main forces tend to be behind sudden sell-offs. First, the US dollar. When the dollar strengthens, gold and silver, which are priced in dollars, become more expensive for buyers in other currencies. Demand cools and prices drop. Second, Federal Reserve policy expectations. If economic data comes in stronger than expected, futures traders who had been betting on rate cuts or a softer Fed tend to unwind those bets quickly. That repositioning hits gold and silver fast. Silver tends to amplify whatever direction the market is moving. It has a larger industrial demand component than gold, so when risk appetite shifts, silver often falls harder and can bounce back more sharply too. One metric worth tracking right now is the gold to silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. When that ratio moves significantly during a pullback, it tells you which metal is absorbing more selling pressure. For gold specifically, the technical picture comes into focus after a move this size. Traders start looking at key support levels, price zones where buyers have stepped in before, along with moving averages and prior consolidation areas. The core question is whether this is a healthy reset inside a broader uptrend or the early stages of a more meaningful correction. History suggests buyers tend to return during gold pullbacks when the broader backdrop remains intact. Inflation concerns, geopolitical risk, and central bank demand don't evaporate on a single down day. Central bank buying in particular has been a consistent flaw under gold demand for several years running. That doesn't change because of a short-term price swing. That said, when positioning in a rising market gets crowded, meaning a lot of traders are on the same side of the trade, a sell-off can run further than the fundamentals would otherwise justify. The momentum itself becomes a factor. What happens next will likely come down to the next round of economic data, particularly anything that shifts expectations around Fed policy or dollar direction. For now, the practical move is straightforward. Watch the data, watch the dollar, and treat this pullback as information, not a verdict.